Question 1. Which of the following is considered a benefit trigger in most long-term care (LTC) insurance policies? A. The insured's inability to perform one activity of daily living adult. B. The insured's inability to perform two or more activities of daily living adults. C. A diagnosis of a terminal illness. D. The insured's enrollment in Medicaid. Answer: B. The insured's inability to perform two or more activities of daily living adults. Explanation: benefit triggers are specific conditions that must be met for an LTC insurance policy to start paying benefits. In most LTC policies, the inability to perform two or more adults, such as bathing, dressing, or eating, is a common trigger. A DLS are used to measure an individual's functional status and determine their need for long-term care. Option A is incorrect because most policies require the inability to perform at least two adults, not just one. Option C is incorrect because while a terminal illness may qualify for other types of insurance benefits, it is not typically a benefit trigger for LTC insurance. Option D is incorrect because Medicaid enrollment may affect eligibility for certain benefits but is not a standard benefit trigger in LTC policies. Relevant law: the Health Insurance Portability and Accountability Act (HIPAA) defines a DLS and specifies that tax-qualified LTC policies must use the inability to perform two or more DLS as a benefit trigger. Question 2. Scenario-based. Mr. Thompson has a long-term care insurance policy and has recently been diagnosed with early-stage dementia. His cognitive impairment is mild, but his family is concerned about his future care needs. Which of the following options should Mr. Thompson's family consider to ensure his LTC policy will cover his future care needs? A. Wait until Mr. Thompson cannot perform any activities of daily living adults. B. Contact his LTC insurer to determine if cognitive impairment is a benefit trigger under his policy. C. Enroll Mr. Thompson in a Medicare Advantage plan to cover his LTC costs. D. Start using Medicaid services to reduce his LTC insurance benefits usage. Answer: B. Contact his LTC insurer to determine if cognitive impairment is a benefit trigger under his policy. Explanation: in many LTC policies, cognitive impairment, such as dementia or Alzheimer's disease, is considered a benefit trigger even if the insured can still perform adults. Mr. Thompson's family should contact the insurer to verify the policy details and understand how cognitive impairment is covered. Option A is incorrect because waiting until Mr. Thompson cannot perform any DLS may result in a delayed or incomplete use of his benefits. Option C is incorrect because Medicare Advantage plans typically do not cover long-term care services in the same way as LTC insurance policies. Option D is incorrect because using Medicaid services could affect his LTC policy benefits and may not be the most appropriate step if LTC insurance covers his needs. Relevant guidelines: under HIPAA, cognitive impairment such as Alzheimer's is a recognized trigger for LTC benefits if it affects the individual's ability to care for themselves or if supervision is required. Question 3. Which of the following statements about the taxation of long-term care insurance premiums and benefits is correct? A. All long-term care insurance premiums are tax-deductible regardless of the policy type. B. Only premiums for tax-qualified LTC policies can be deductible under certain conditions. C. LTC benefits are always taxable as income when received by the policyholder. D. LTC insurance premiums cannot be deducted as medical expenses on federal taxes. Answer: B. Only premiums for tax-qualified LTC policies can be deductible under certain conditions. Explanation: under federal tax law, only premiums paid for tax-qualified LTC insurance policies can be deducted as medical expenses, subject to certain conditions. These premiums are considered part of medical expenses and can be deducted if they exceed a specific percentage of the taxpayer's adjusted gross income. OGI. Option A is incorrect because non-tax qualified policies do not provide the same tax deductions. Option C is incorrect because LTC benefits are generally not considered taxable income when received, as long as they do not exceed certain limits. Option D is incorrect because tax-qualified LTC premiums can indeed be included in medical expenses for deduction purposes. Relevant law: the Health Insurance Portability and Accountability Act (HIPAA) provides guidelines on tax-qualified LTC policies and the taxation of premiums and benefits. Question 4. Which of the following is not considered a prohibited provision in long-term care LTC insurance policies in Virginia? A. Post-claims underwriting. B. Policy cancellation for reasons other than non-payment of premiums. C. Free look period of 30 days. D. Requiring that the insured's condition must improve before receiving benefits. Answer: C. Free look period of 30 days. Explanation: the free look period is a consumer protection feature allowing policyholders to cancel the policy and receive a full refund within a certain period, typically 30 days. This is not a prohibited provision, instead, it's a required consumer protection. Option A is incorrect because post-claims underwriting denying coverage after a claim is made due to undisclosed health conditions is prohibited under Virginia law. Option B is incorrect because cancelling policies for reasons other than non-payment of premiums is prohibited. Option D is incorrect because LTC policies cannot require that. A condition must improve before receiving benefits. Relevant law: Virginia Code outlines several prohibited provisions in LTC policies, such as post-claims underwriting and unfair cancellation practices. Question 5. Which of the following factors typically does not influence the cost of long-term care insurance premiums? A. The insured's health status at the time of application. B. The insured's gender. C. The insured's financial income. D. The insured's age at the time of purchase. Answer: C. The insured's financial income. Explanation: the cost of LTC insurance premiums is influenced by several factors, including the insured's health, gender, and age at the time of application. However, the individual's financial income typically does not affect the premium amount that can affect the policy's suitability. Option A is incorrect because health status significantly affects premium costs due to underwriting. Option B is incorrect because women often pay higher premiums than men due to their longer life expectancy. Option D is incorrect because older applicants usually pay higher premiums than younger applicants. Relevant guidelines: insurers assess risk based on factors like age, gender, and health, but financial income mainly affects policy affordability, not the premium amount. Question 6. Scenario-based. MS Johnson purchased a long-term care insurance policy that includes inflation protection. Her daily benefit amount started at $150 per day. If she selected a 5% compound inflation protection option, what would her daily benefit be after 5 years? A. $157.50. B. $187.50. C. $191.44. D. $195. Answer: C. $191.44. Explanation: with a 5% compound inflation protection option, the benefit amount increases annually by 5%, compounded on the previous year's benefit amount. Using the formula, benefit after 5 equals 150x 1.55 squeals 191.44. Thus, after 5 years, the daily benefit would be approximately $191.44. Option A is incorrect because it reflects a simple percentage increase without compounding. Option B is incorrect as it underestimates the compounded growth. Option D is incorrect as it overestimates the compounded growth. Relevant law: Virginia's insurance regulations require LTC policies to offer inflation protection, which can be either simple or compound. Question 7. Which of the following is true about the Virginia Long-Term Care Insurance Partnership Program? A. It allows policyholders to protect an equivalent amount of assets from Medicaid spend-down requirements. B. It guarantees that LTC insurance premiums will not increase. C. It requires all policies to be tax qualified. D. It provides coverage for individuals regardless of pre-existing health conditions. Answer A. It allows policyholders to protect an equivalent amount of assets from Medicaid spend-down requirements. Explanation: the Virginia Long-Term Care Insurance Partnership Program allows policyholders to protect assets equivalent to the amount of benefits paid by the LTC insurance policy. This feature helps policyholders qualify for Medicaid while preserving more of their assets than typically allowed under Medicaid rules. Option B is incorrect because the program does not guarantee premium stability. Option C is incorrect. While many partnership policies are tax qualified, it's not a universal requirement. Option D is incorrect because policies may still have underwriting requirements for pre-existing conditions. Relevant law: the Deficit Reduction Act of 2005 introduced partnership programs to incentivize purchasing LTC insurance by offering asset protection. Question 8. Which of the following would typically not be included in a long-term care insurance policy's elimination period? A. The number of days the insured must wait before receiving benefits. B. The requirement for the insured to receive care in a qualified facility during the waiting period. C. A deductible that must be paid before the policy pays out benefits. D. The days during which the insured is covered by Medicare or another insurance plan. Answer: C. A deductible that must be paid before the policy pays out benefits. Explanation: Elimination periods in LTC policies refer to the number of days the insured must wait before benefits begin, similar to a waiting period, but do not involve paying a deductible. Option A is incorrect because elimination periods do require a waiting period before benefits are paid. Option B is incorrect because some policies may require care to be provided in a facility during the waiting period. Option D is incorrect because time during which the insured is covered by another insurance like Medicare does not count toward the elimination period. Relevant guidelines. Elimination periods are designed to delay benefit payments, reducing policy costs, but they do not include deductible payments. Question 9. Scenario-based. Mr. Garcia has a traditional long-term care policy that pays benefits on a reimbursement basis. He incurred $3,000 in monthly long-term care expenses, but his policy has a $2,500 monthly benefit limit. How much will his insurance company reimburse him for that month's expenses? A. $0. B. $2,000. C. $2,500. D. $3,000. Answer. C. $2,500. Explanation. A reimbursement-based LTC policy reimburses the insured for actual long-term care expenses up to the policy's benefit limit. Since Mr. Garcia's expenses exceed his policy's $2,500 limit, he will be reimbursed $2,500 for that month. Option A is incorrect because the insurance will reimburse up to the limit. Option B is incorrect because $2,500, not $2,000, is the policy limit. Option D is incorrect because the policy won't reimburse for more than the $2,500 limit. Relevant rules. Virginia LTC policies must specify whether they pay on a reimbursement or indemnity basis, and reimbursement policies will only pay up to the policy's specified limit. Question 10. In Virginia, which of the following is a required consumer protection for long-term care insurance policyholders? A. A waiver of premium after the first claim is paid. B. An automatic return of premiums if no claims are made. C. A guaranteed renewability feature. D. A reduction in premiums after 10 years of continuous coverage. Answer. C. A guaranteed renewability feature. Explanation. In Virginia, LTC insurance policies are required to have a guaranteed renewability feature, meaning the policy cannot be cancelled as long as premiums are paid. Option A is incorrect because a waiver of premium is often included but not required after the first claim. Option B is incorrect because return of premium is an optional rider, not a mandatory feature. Option D is incorrect because premium reductions after 10 years are not a mandated requirement. Relevant law. Virginia law mandates that LTC policies must include guaranteed renewability to protect policyholders from unfair cancellations. Question 11. Which of the following is not a qualifying event for long-term care insurance benefits to begin in Virginia? A. The inability to perform at least 2 activities of daily living adults. B. A severe cognitive impairment requiring supervision. C. A temporary disability lasting fewer than 30 days. D. Certification by a physician that long-term care services are medically necessary. Answer. C. A temporary disability lasting fewer than 30 days. Explanation. Long-term care insurance benefits are typically triggered by the insured's inability to perform at least 2 DLS or by a cognitive impairment requiring supervision. A temporary disability that lasts fewer than 30 days is not usually sufficient to trigger benefits, as most policies require conditions to be chronic or expected to last longer than a specified period. Option A is incorrect because inability to perform 2 DLS is a common benefit trigger. Option B is incorrect because cognitive impairments that require supervision can trigger benefits. Option D is incorrect because a physician's certification of medical necessity is often required. Relevant law. Virginia LTC policies define qualifying events, and these typically require conditions that last longer than a short-term disability. Question 12. Which of the following does not affect the premium costs for long-term care insurance in Virginia? A. Elimination period length. B. Policyholder's occupation. C. Daily benefit amount. D. Length of benefit period. Answer. B. Policyholder's occupation. Explanation. The premium cost for long-term care insurance is determined by factors like elimination periods, daily benefit amounts, and benefit duration, but the policyholder's occupation is generally not a factor unless it directly affects the insured's health or long-term care risk. Option A is incorrect because a longer elimination period typically reduces premium costs. Option C is incorrect because higher daily benefits result in higher premiums. Option D is incorrect because longer benefit periods increase premiums. Relevant guidelines. Premium rates are influenced by coverage features, not typically by the policyholder's job. Question 13, scenario-based. MS. Smith purchased a long-term care policy with a $200 daily benefit. Her policy has a 90-day elimination period and pays benefits on an indemnity basis. If she enters a nursing home and incurs $180 per day in expenses, how much will she receive in benefits per day after the elimination period is met? A. $0. B. $180. C. $200. D. The lesser of her actual expenses or the policy benefit. Answer. C. $200. Explanation. Indemnity-based long-term care policies pay a set amount regardless of the actual cost of care, as long as the care qualifies under the policy terms. Since her policy has a $200 daily benefit, MS. Smith will receive that amount after the 90-day elimination period, even though her expenses are only $180 per day. Option A is incorrect because she will receive benefits after the elimination period. Option B is incorrect because this is the reimbursement amount, not the indemnity amount. Option D is incorrect because indemnity policies don't limit payments to actual expenses. Relevant law. Indemnity-based LTC policies pay a set amount, unlike reimbursement policies, which cover actual expenses up to the benefit limit. Question 14. What is the primary purpose of Virginia's long-term care partnership program? A. To offer tax deductions for premiums paid. B. To reduce the need for Medicaid assistance. C. To provide discounted premiums for certain individuals. D. To extend the benefit period of long-term care insurance policies. Answer. B. To reduce the need for Medicaid assistance. Explanation. The Virginia Long-Term Care Partnership Program is designed to encourage the purchase of private LTC insurance by allowing policyholders to protect an equivalent amount of assets from Medicaid spend-down requirements. This helps reduce reliance on Medicaid for long-term care services. Option A is incorrect because the primary goal is not related to tax deductions. Option C is incorrect as the program does not provide discounted premiums. Option D is incorrect because it does not extend benefit periods. Relevant guidelines. The partnership program encourages asset protection, helping individuals preserve more wealth while qualifying for Medicaid. Question 15. What does Virginia law require all long-term care insurance policies to offer? A. Unlimited lifetime benefits. B. Guaranteed insurability options. C. Non-forfeiture benefits. D. Optional coverage for respite care. Answer. C. Non-forfeiture benefits. Explanation. Virginia law requires LTC policies to offer non-forfeiture benefits, which protect policyholders from losing all benefits if they lapse on premium payments. These benefits may come in the form of reduced paid-up coverage or a return of some of the premiums paid. Option A is incorrect because policies are not required to offer unlimited lifetime benefits. Option B is incorrect because guaranteed insurability is not required, although it may be an option in some policies. Option D is incorrect because respite care coverage is optional and not required. Relevant law. Non-forfeiture options are mandatory offers in Virginia LTC policies to provide some protection for policyholders who stop paying premiums. Question 16, scenario-based. Mr. Turner has a long-term care policy with a $100,000 lifetime maximum benefit. He has already used $25,000 in benefits. If he enters a nursing home with costs of $6,000 per month, how many more months of coverage will he have remaining? A. 12 months. B. 16.67 months. C. 20 months. D. 25 months. Answer. B. 16.67 months. Explanation. Mr. Turner has $75,000 remaining in his lifetime benefit, $100,000, $25,000. To determine how many more months he can receive coverage, divide the remaining benefit by his monthly expenses. Remaining money equals 75,006 equals 12.5 months. Thus, Mr. Turner will have about 16.67 months of coverage remaining. Option A is incorrect because it underestimates the remaining months. Option C and D are incorrect because they overestimate the remaining coverage. Question 17. What is the maximum free look period for long-term care insurance policies in Virginia? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer. C. 30 days. Explanation. Virginia law mandates that LTC insurance policies must provide a 30-day free look period during which policyholders can cancel their policy and receive a full refund of premiums paid if they are not satisfied. Option A and B are incorrect because these are shorter free look periods. Option D is incorrect because the maximum free look period is 30 days, not 45 days. Relevant law. A 30-day free look period is required to protect consumers by allowing them to reconsider their purchase after reviewing the policy details. Question 18. What does guaranteed renewable mean for long-term care insurance policies in Virginia? A. The policyholder can renew the policy without evidence of insurability. B. The insurance company can only cancel the policy if the insured's health condition changes. C. The premiums are guaranteed not to increase. D. The policyholder can increase benefits without a medical exam. Answer A. The policyholder can renew the policy without evidence of insurability. Explanation. Guaranteed renewable means that the insurer cannot cancel the policy as long as premiums are paid, and the policyholder does not need to provide evidence of insurability, such as a medical exam, to continue coverage. Option B is incorrect because health condition changes do not affect renewal rights. Option C is incorrect because premiums can still increase for all policyholders. Option D is incorrect because guaranteed renewability does not relate to benefit increases. Question 19. Under Virginia law, long-term care insurance policies must cover care in which of the following settings? A. Only skilled nursing facilities. B. Only adult day care centers. C. Only in-home care. D. A range of settings including nursing homes, assisted living, and in-home care. Answer D. A range of settings including nursing homes, assisted living, and in-home care. Explanation. Virginia requires that LTC policies offer coverage for a range of care settings including nursing homes, assisted living facilities, and in-home care, depending on the needs of the insured. Options A, B, and C are incorrect because LTC policies are not restricted to just one care setting. Relevant guidelines. Comprehensive LTC policies must cover a variety of care environments to meet the diverse needs of policyholders. Question 20. Which of the following services is typically not covered by a long-term care insurance policy? A. Assistance with bathing and dressing. B. 24-hour skilled nursing care. C. Hospice care. D. Cosmetic surgery after an accident. Answer D. Cosmetic surgery after an accident. Explanation. Long-term care insurance is designed to cover services related to personal care, such as assistance with activities of daily living, adults, skilled nursing care, and hospice care for individuals with chronic illness or disabilities. Cosmetic surgery, even after an accident, is generally considered elective and is not covered under most long-term care policies. Option A is incorrect because assistance with bathing, dressing, and other ADLS a core component of LTC coverage. Option B is incorrect because 24-hour skilled nursing care is often covered under LTC policies. Option C is incorrect because hospice care, which provides comfort and support for those with terminal illnesses, is typically covered. Relevant law. Virginia LTC policies focus on non-elective medically necessary services rather than elective or cosmetic procedures. Question 21. Which of the following is not a typical feature of hybrid long-term care insurance policies? A. Life insurance component. B. Return of premium option. C. Unlimited benefit period. D. Long-term care rider. Answer. C. Unlimited benefit period. Explanation. Hybrid long-term care policies often combine a life insurance component with a long-term care rider and may include options for a return of premium. However, unlimited benefit periods are not a standard feature and may not be available in these types of policies. Option A is incorrect because the life insurance component is a defining feature of hybrid policies. Option B is incorrect as many hybrid policies do offer a return of premium option. Option D is incorrect since the long-term care rider is essential to the hybrid policy's functionality. Relevant guidelines. Hybrid policies combine features of life insurance and long-term care, providing flexibility but typically with set limits on benefits. Question 22. What is the primary purpose of an inflation protection option in a long-term care insurance policy? A. To ensure premium payments do not increase. B. To maintain the purchasing power of benefits over time. C. To guarantee access to care providers. D. To provide a death benefit for beneficiaries. Answer. B. To maintain the purchasing power of benefits over time. Explanation. Inflation protection options help to ensure that the benefits available under the policy keep pace with the rising costs of long-term care services, thereby maintaining the policyholder's purchasing power. Option A is incorrect as inflation protection does not directly impact premium increases. Option C is incorrect because inflation protection does not guarantee access to providers. It pertains to benefit amounts. Option D is incorrect since the death benefit is not the purpose of inflation protection. Relevant law. Many states, including Virginia, require LTC policies to offer inflation protection to ensure policyholders are not adversely affected by rising healthcare costs. Question 23, scenario-based. Mr. Lee is evaluating his long-term care insurance options. He is 65 years old and has a pre-existing condition that may impact his eligibility for coverage. Which of the following actions should he take to improve his chances of obtaining a policy? A. Apply for coverage only after his health condition improves. B. Seek out guaranteed issue policies that do not require medical underwriting. C. Delay his application until he turns 70 for better rates. D. Avoid discussing his pre-existing condition during the application process. Answer: B. Seek out guaranteed issue policies that do not require medical underwriting. Explanation: for individuals with pre-existing conditions, guaranteed issue policies are beneficial because they do not require medical underwriting, making it easier for Mr. Lee to obtain coverage without being denied due to his health condition. Option A is incorrect since waiting for health improvement may not guarantee better options. Option C is incorrect. A delay could lead to higher rates due to age or deteriorating health. Option D is incorrect as failing to disclose pre-existing conditions can lead to policy denial or coverage limitations. Relevant guidelines. Many LTC policies have specific eligibility criteria related to health status, and guaranteed issue policies provide an alternative for those with health concerns. Question 24. In Virginia, which of the following must long-term care insurance policies clearly disclose to potential policyholders? A. The policy's total lifetime benefit amount. B. The company's financial stability rating. C. The likelihood of a premium increase. D. The cost of care in different facilities. Answer: C. The likelihood of a premium increase. Explanation: Virginia law mandates that long-term care insurance policies disclose potential premium increase risks to ensure consumers understand how their premiums may change over time. Option A is incorrect. While the lifetime benefit amount is important, it is not specifically required for disclosure. Option B is incorrect as financial stability ratings are not mandated disclosures. Option D is incorrect since specific care costs are not typically required disclosures. Relevant law. Disclosure requirements aim to protect consumers by ensuring they are informed about their policy's financial implications. Question 25. Which of the following statements regarding Virginia's long-term care partnership program is true? A. It allows individuals to retain assets equal to the amount of benefits paid by their LTC policy. B. It requires participants to spend down all assets before qualifying for Medicaid. C. It only applies to individuals with disabilities. D. It restricts the types of long-term care insurance policies that can be purchased. Answer A. It allows individuals to retain assets equal to the amount of benefits paid by their LTC policy. Explanation: the long-term care partnership program enables individuals to keep a portion of their assets equivalent to the benefits received from their long-term care insurance, helping them qualify for Medicaid without complete spend down. Option B is incorrect because the partnership program is designed to reduce the need for full asset spend down. Option C is incorrect. It applies to all individuals who purchase qualifying policies, not just those with disabilities. Option D is incorrect as the program does not limit the types of policies but encourages certain features. Relevant guidelines. The partnership program promotes private insurance by allowing policyholders to protect assets while accessing Medicaid. Question 26. Which of the following is a potential drawback of using long-term care insurance as a financial planning tool? A. It provides tax-free benefits under federal law. B. It requires ongoing premium payments that can increase over time. C. It ensures access to high-quality long-term care providers. D. It may reduce estate value upon the policyholder's death. Answer: B. It requires ongoing premium payments that can increase over time. Explanation: one significant drawback of long-term care insurance is that policyholders must pay premiums continuously, and those premiums can increase as the policyholder ages or as health care costs rise, potentially leading to affordability issues. Option A is incorrect because tax-free benefits are an advantage, not a drawback. Option C is incorrect. While it may offer access to providers, it does not guarantee quality. Option D is incorrect since the policy generally pays benefits rather than directly reducing estate value. Relevant law. The potential for premium increases highlights the importance of understanding financial obligations associated with LTC insurance. Question 27, scenario-based. Mrs. Gonzalez has a long-term care policy with a daily benefit of $150 and an elimination period of 60 days. And after needing care for 70 days, she receives a total of $7,500 in benefits. How much of her total care costs did she cover out of pocket? A. $3,000. B. $4,500. C. $6,000. D. $7,500. Answer A. $3,000. Explanation. To calculate Mrs. Gonzalez's out-of-pocket costs, we first determine her total care costs over the 70 days. Total care cost equals 150 x 7 equals 10,500. Next, we factor in her 60-day elimination period during which she did not receive benefits. Cover D equals 70. Sic equals total benefits received equals 150 x equals 1,500. Now, to find out how much she paid out of pocket, we subtract the benefits from the total costs. Out of pocket is and 500. 1,500 will sign 1,000. Thus, Mrs. Gonzalez covered $3,000 out of pocket for her care. Option B is incorrect because it miscalculates the out-of-pocket expenses. Option C is incorrect for the same reason. Option D is incorrect as it suggests she did not pay anything out of pocket. Question 20. What is a waiver of premium in the context of long-term care insurance? A. A clause that allows a policyholder to stop paying premiums after age 65. B. A provision that eliminates premium payments while the policyholder is receiving benefits. C. A refund of premiums if the policyholder dies within the first year. D. A discount on premiums for early enrollment. Answer. B. A provision that eliminates premium payments while the policyholder is receiving benefits. Explanation. A waiver of premium allows policyholders to stop paying premiums while they are receiving long-term care benefits. This provision ensures that the insured does not have to pay out of pocket for premiums while also needing care. Option A is incorrect because waiving premiums is not tied to age but to benefit eligibility. Option C is incorrect. There is usually no refund of premiums for early death unless specified in the policy. Option D is incorrect as discounts are not typically related to the waiver of premium. Relevant guidelines. The waiver of premium is a critical feature in LTC policies, making it financially easier for policyholders to maintain coverage while receiving care. Question 29. In Virginia, what must long-term care insurance policies include regarding pre-existing conditions? A. Complete denial of coverage for all pre-existing conditions. B. A waiting period during which claims related to pre-existing conditions are not covered. C. An unlimited coverage option for pre-existing conditions after 1 year. D. A disclosure of any limitations or exclusions due to pre-existing conditions. Answer. D. A disclosure of any limitations or exclusions due to pre-existing conditions. Explanation. Virginia law requires that long-term care insurance policies clearly disclose any limitations or exclusions related to pre-existing conditions. This ensures that consumers are aware of how these conditions may affect their coverage and what to expect when applying for benefits. Option A is incorrect as long-term care insurance does not universally deny coverage for all pre-existing conditions. It varies by policy. Option B is partially correct. While many policies do include a waiting period for claims related to pre-existing conditions, the essential requirement is to disclose these limitations. Option C is incorrect because there is typically no unlimited coverage option specifically for pre-existing conditions after a year. Policies vary in their terms. Relevant guidelines. The disclosure requirements aim to provide transparency to policyholders regarding how their health status can affect their insurance coverage. Question 30. What is the primary function of the Virginia Bureau of Insurance in relation to long-term care insurance? A. To create long-term care insurance policies. B. To provide financial assistance to policyholders. C. To regulate and oversee the long-term care insurance market in Virginia. D. To directly sell long-term care insurance products. Answer. C. To regulate and oversee the long-term care insurance market in Virginia. Explanation. The Virginia Bureau of Insurance is responsible for regulating and overseeing the insurance market within the state, including long-term care insurance. This includes ensuring compliance with state laws, protecting consumers, and maintaining market integrity. Option A is incorrect. The Bureau does not create policies, but regulates the companies that do. Option B is incorrect. Financial assistance to policyholders is not a primary function of the Bureau. Option D is incorrect because the Bureau does not sell insurance products. It oversees and regulates the insurance industry. Relevant guidelines. Regulatory bodies like the Virginia Bureau of Insurance play a crucial role in consumer protection and maintaining the ethical conduct of insurance companies.